Okay, good morning and welcome back everyone to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at Options Play. And last week we had a bit of an emotional roller coaster last week. Started off with a bang with the Apple AI developer conference that added a lot of optimism to the largest company in the world on Tuesday. Wednesday morning, we had the cooler than expected inflation print that really accelerated optimism here in the overall markets. And then we had the Fed meeting on Wednesday, which poured a little bit of cold water on that optimism with regards to the Fed's insistence that they're going to take things slow from a data dependency perspective, and that there are at the moment still pricing in one more rate cut rather than the two that perhaps the data might have suggested we are ready for. But largely, investors have shrugged off the Fed's language and responded more so to the underlying data itself, which was showing the fact that um, inflation was coming in cooler than expected. So that is the optimism that we carry into the markets here this week. We have the S&P 500 making new all-time highs this week. That actually has been confirmed by momentum here on the S&P 500. You see the same thing here on the NASDAQ 100 making new all-time highs, confirmed by those new all-time highs. The biggest concern that we saw here from equities last week was the fact that as the S&P and NASDAQ made new highs, the IWM small cap ETF was making actually new relative lows. Now, we did see a bit of this correct a little bit here yesterday, but largely we're still seeing a lack of participation on equities as the S&P and NASDAQ make new all-time highs. And that's one of the concerning things that we do see with the equity rally here right now. It's just overall the lack of participation here and just how far behind small caps, and even when we look at equal weight S&P 500 index, how far behind these two indices are relative to the S&P 500. We've seen small caps and equal weight lose nearly 5% of relative performance in just 2 weeks' time. That's a really large percentage of underperformance in such a short period of time when you compare some of these major indices to the S&P and the NASDAQ. So what we're really seeing is that there's a few stocks that are dragging the markets higher, and at the same time, the vast majority of stocks are not responding to this optimism and the equity rally. And it's just a few and fewer stocks that are concentrated at the very top that are generating this performance that is contributing to the major indices printing new all-time highs, while the rest of the market really is not moving much at all, if anything, moving in the opposite direction. So those are some of the concerns that we generally have with the overall equity markets. There are still plenty of, I would say, bright spots in terms of equities. This really has two ways that it can play out. Either the few concentrated stocks where all the performance is coming from starts to roll over, and that's really where you have some downside risks here in terms of equities. Or the other way that this can be played out is the fact that all the underperforming stocks that have been left behind start outperforming again or start performing now and play catch up. So those are the two different scenarios that they can play out. And as of yesterday, we started to see a little bit of catch up here last week. The question with the broader equity markets. The question is whether or not that catch-up play can continue and whether that can sustain itself. Because if that does happen, we have ourselves a very clear bullish signal here for the equity markets, and vice versa. If the few tech stocks that are dragging the markets higher no longer outperform and start to pull back, that's really where we do see some downside risks with equities. At the moment, it very much feels like the catch-up play is starting to play out, and we'll continue to monitor that and see how that plays out over the next few trading sessions and the next few trading weeks. Um, Growth outperforming value here has gotten to a bit of an extreme here. We see the overall trend that growth outperforms value, but notice how steep this outperformance has been in the past 2 weeks or so. We have seen growth outperform value by a very large margin in just 2 weeks' time. So this is something to be aware of with regards to kind of that outperformance is reaching a bit of an extreme level here at the moment. Doesn't mean it can't continue. It's just important to be aware of that. You see commodities rally back up to a major resistance level, which is the 50-day moving average. This, in my opinion, will in the short run put a little bit of a cap here in terms of the outperformance for commodities. We've seen commodities outperform S&P as an asset class for the past couple of months, but I'm sorry, a few months ago. But then over the past couple of months, we have really started to see commodities underperform as an asset class. And the levels that we are right now, the risk reward certainly favors potentially some further underperformance. This is the case for gold, for equity, for oil, as well as some of the base metals. If you have exposure to either those commodities themselves or some of the producers of those commodities at the moment. High yield corporate bonds, HYG, so far has really still continued to fail to break out here from this trading range that it's been in. We were looking for the breakout here to the upside as a risk on signal here for equities. But so far, it's traded back into the trading range. So still on the neutral sidelines, not a strong indication of risk on or risk off at the moment, much more in that neutral territory right now coming from high yield bonds. If you look at VIX here, we're still stuck kind of below the 13 level here in terms of VIX. We've really been stuck in sort of this 12, 13 range here over the past month and a half here. It's starting to feel a little bit more like a new low volatility regime that we're kind of stuck in. I still believe that this becomes a opportunity for options traders to be long volatility, whether that's through long calls or long puts in the stocks that you have a bullish or bearish view on. The opportunities are for the fact that since volatility expectations are so low, that any expansion in volatility would benefit option buyers in this current market environment. You have the 10-year yield continue to moderate around that 4.2 level. So we've seen a pretty significant decline from that 4.5 to 4.2 level here over the past couple of weeks, providing a bit of a tailwind here for equities to continue moving higher as rates move lower. And this is, again, in response to the inflation data that we saw here last Wednesday. Markets largely shrugging off Chairman Powell's language and commentary with regards to expectations for only one rate cut here right now. Markets are pricing in 2 rate cuts, really focusing more so on the actual data, the economic data, rather than what the Fed is saying. You can either agree or disagree with that view as to whether or not it makes sense for the bond markets to be playing chicken with the Fed. But the reality is that the bond market is doing that. And, that is, you could think of that as an opportunity if you disagree with that view. You see TLT has broken out above this bearish trend line that we've been paying attention to here for the past couple of weeks. We broke out here a couple of weeks ago, retested that as support here last week, and on the back of that CPI print, has continued to break out higher here. So this is constructive, I would say, for bonds to continue to rally from here. That would certainly provide a backdrop of lower yields, which again would be more supportive here for equities. So bonds currently setting up for further upside potential from here. You see the dollar index is broken out above this 105 resistance level. This is one where there could be some further upside here for the US dollar going forward. Looking at gold, we see gold recently stalling at that 50-day moving average, which is coming around 2350 or so, providing some temporary resistance here right now. Gold call it trading in a range between 2450 and 2300, but so far kind of getting pinned below the 50-day moving average, certainly at risk of potentially breaking below this trading range that's been set, between 2300 and 2450. Further downside would certainly be bearish for gold miners, mining stocks in general. So if you're exposed to either gold or exposed to those specific mining stocks, be aware of a potential breakdown below 2300 on gold. We have seen oil here rally back up to this $80 level, which also corresponds to the 50-day moving average. My expectation is that in the short run, that will provide a little bit of a meaningful resistance here in the short run. But if we do break out above that $80 level, that starts to open this thing back up, towards that $88 high that we saw here a couple of months ago. So pay attention to this $80 level here right now. And how oil responds to that. We have seen a pretty nice rally here over the past couple of weeks. And I do think that perhaps in the short run, you see a little bit of resistance here into that $80 level for oil. And then looking at the sectors, this is really where the story that I was talking about before, technology being the primary mover here, is really one of the concerns that we have with the equity markets. You can't have equity markets continue to move higher with just one sector dragging the markets higher. And that's been technology. You look at this outperformance of technology relative to the S&P 500. We're talking about over 5% outperformance in just a couple of weeks' time. You usually don't see that type of outperformance from a single sector. And then at the same time, the rest of the other sectors continue to fall behind. You see consumer discretionary largely flat here over the past couple of weeks. And then you look at communications falling quite a bit behind here over the past couple of weeks. These are not healthy conditions where materials, financials, consumer staples, healthcare, materials. Look at how far behind each of these sectors are falling behind the S&P 500 in such a short period of time. These are concerning when you have just one sector moving higher and every other sector is either flat or falling behind. Utilities, energy, all across the board, losing a fair amount of relative strength here. So this is something that is continuing to concern me with the equity markets right now. And then home builders, we see home builders continue to underperform here as well. And the only sector that's outperforming here right now is semiconductors. The one sector, with technology that's continuing to move higher here in this equity market right now. So that's really the biggest concern that we see here with the equity markets right now is the fact that you don't have participation. We could potentially start to see participation improve here over the next couple of weeks. And that's really what we're paying attention to here right now. With that covers what I wanted to share with you here right now. I hope that this gives you a better understanding as to how to go about starting your week with regards to the equity markets. Thank you so much and have a great trading day.